For weeks, the phrase "gold at record highs" had saturated headlines to the point of numbness. Investors had grown accustomed to seeing gold behave as the calm, immovable anchor in a world of volatility. That illusion shattered violently on the 30th of January 2026. Within a single trading session, more precisely, in less than 1 hour, the global gold market staged one of the most brutal collapses in its modern history. From an all-time high near $5,600 per ounce, prices plunged straight down to approximately $4,700, erasing nearly $900 in value almost instantly. In percentage terms, the decline approached 20%, a level of intraday volatility typically associated with highly speculative assets like cryptocurrencies, not with gold, a metal that has symbolized stability for thousands of years. The speed of the collapse was as shocking as its magnitude. There were no gradual warning signs, no extended distribution phase, and no time for repositioning. Charts did not slope downward, they collapsed vertically. In financial markets, a 20% move in a single day is already considered extreme. A 20% move in under an hour represents something far more disturbing, a breakdown of normal market mechanics. As the sell-off intensified, forced liquidations began cascading across trading platforms worldwide. By the end of the session, more than 270,000 trading accounts had been wiped out through mandatory margin liquidations, turning what had been paper profits just hours earlier into realized losses on a massive scale. The psychological damage was immediate and severe. Only hours before the crash, investors were still calculating gains from gold's relentless rally. By nightfall, trading screens were dominated by liquidation notices and emergency stop-outs. Gold, long perceived as the ultimate safe haven, suddenly behaved like a high-beta risk asset. This contradiction struck at the core of investor confidence. While prices managed a modest technical rebound in the following hours, recovering to around $4,845 per ounce, the recovery did little to heal sentiment. A bounce of $100 to $150 felt insignificant compared to the scale of destruction that had just unfolded. What made this event truly historic was not merely the loss in price, but the collapse in belief. The gold market had just demonstrated that even the most trusted asset could experience extreme instability under modern market conditions. The events of the 30th of January 2026 were not simply a correction, they were a stress test of the global financial system's emotional and structural resilience, and gold had been pulled directly into the blast radius. What made the collapse of gold on the 30th of January 2026 so difficult for investors to process was a simple but unsettling fact. The trigger did not come from the gold market itself. There was no sudden surge in mine supply, no collapse in jewelry demand, and no central bank announcement that altered long-term fundamentals. The initial shockwave originated thousands of miles away, inside the U.S. equity market, specifically within the technology sector that had been powering global risk appetite for years. As the U.S. trading session opened, attention rapidly shifted from precious metals to Wall Street, where one of the most heavily owned stocks in the world began to unravel. The epicenter was Microsoft. During the session, Microsoft shares fell by approximately 12% in a single day, marking the company's worst trading performance in nearly 6 years. For a firm with a market capitalization measured in trillions of dollars, a double-digit decline is not a routine fluctuation. It represents the destruction of value comparable to the annual GDP of several smaller economies combined. Crucially, the sell-off was not driven by weak revenue figures or an earnings miss. Instead, it was the cost side of the balance sheet that triggered panic. Microsoft disclosed that its capital expenditures related to artificial intelligence infrastructure had surged to roughly $37.5 billion USD, primarily for data centers, advanced chips, and cloud-based AI systems. This number immediately unsettled investors. The market's central question was brutally simple: where is the return? Pouring tens of billions of dollars into AI may secure long-term dominance, but in the short term it compresses margins, strains cash flow, and raises doubts about capital efficiency. As these concerns spread, a broader narrative began to take hold that the AI boom, which had driven U.S. technology stocks to extreme valuations throughout 2024 and 2025, was beginning to resemble a classic, speculative bubble. Once confidence cracked in Microsoft, it did not stop there. Selling pressure rippled outward, dragging down the Nasdaq and triggering a coordinated retreat across the entire technology sector. By the end of the session, what had started as a company-specific reassessment had evolved into a systemic shock. Trillions of dollars in paper wealth were suddenly at risk. Risk management systems across hedge funds and institutional portfolios were flashing red, and liquidity demands were rising rapidly. It was this abrupt collapse in U.S. technology equities, not any weakness in gold itself, that set the stage for the violent chain reaction that would soon engulf the precious metals market. Once the shock from U.S. technology stocks spread across Wall Street, the mechanism that ultimately dragged gold into freefall began to operate with ruthless efficiency. This mechanism is known among institutional investors as liquidity contagion, or forced cross-asset liquidation. In modern portfolio construction, large hedge funds and asset managers rarely hold a single type of asset in isolation. A typical institutional portfolio in early 2026 simultaneously held high-growth U.S. technology equities such as AI-driven stocks and defensive assets like gold to hedge against macroeconomic risk. Under normal conditions, this diversification works. Under stress, it becomes a vulnerability. When technology stocks collapsed, led by Microsoft's 12% single-day decline on the 30th of January, 2026 portfolio losses instantly breached predefined risk thresholds. At that moment, automated risk management systems and prime brokers intervened. Margin calls were triggered across the system, demanding immediate injections of cash to maintain leveraged positions. These demands were not negotiable and not theoretical. Funds were required to raise liquidity within hours, not days. Failure to comply meant forced liquidation by brokers at market prices. Faced with this pressure, fund managers scanned their portfolios for assets that could be sold quickly, in size, and with certainty. Technology stocks were collapsing, and buyers had vanished. Corporate bonds were illiquid and slow to settle. Treasuries were already pledged as collateral. That left one asset standing out above all others: gold. Deep global liquidity, tight spreads, continuous trading across Asia, Europe, and the United States. In that moment, gold ceased to function as a safe haven. It became a cash extraction tool. The selling was not discretionary. Funds were not expressing a bearish view on gold's long-term value. They were responding to mechanical survival constraints. Gold was sold because it could be sold. As liquidation orders hit the market simultaneously from dozens of large players, supply overwhelmed demand in an extremely compressed time window. This is how gold, an asset backed by centuries of trust, was transformed into the primary casualty of a crisis that did not originate within its own market. The result was a brutal inversion of expectations. At precisely the moment when retail investors assumed gold would rise as equities fell, institutional capital was dumping gold to save equity portfolios from collapse. In systemic crises, assets do not fall based on their quality, but on their liquidity. What transformed an already violent sell-off into a full-scale market disaster was not human panic, but machine logic. By 2026, more than 90% of global trading volume across futures, equities, and commodities was executed not by people, but by algorithms and high-frequency trading systems. These machines are designed to provide liquidity during calm conditions and to withdraw instantly when risk becomes unquantifiable. On the 30th of January, 2026, that design feature became the accelerant. As forced selling from hedge funds flooded into the gold market, price volatility rapidly breached predefined safety thresholds embedded in trading algorithms worldwide. These thresholds are not subjective judgments. They are hard-coded risk limits based on historical variance, order book depth, and execution latency. Once those limits were crossed, the response was automatic and simultaneous. Algorithms began to cancel all resting buy orders within milliseconds. Market makers stepped away. Bid depth collapsed. Liquidity, which had appeared abundant seconds earlier, vanished almost entirely. This withdrawal created what traders refer to as a liquidity vacuum. Sellers were still active, driven by margin calls and forced liquidation, but buyers had disappeared. With no bids to absorb supply, prices could only move in one direction downward. Between approximately 28 and 30 minutes, the gold price traced a near vertical decline on intraday charts, slicing through every technical support level without resistance. Stop-loss orders were triggered en masse, adding further sell pressure into an already empty market. Critically, this collapse did not reflect a reassessment of gold's intrinsic value. It reflected a temporary structural failure of market plumbing. Algorithms that normally stabilize prices behaved like umbrellas in fair weather, present when conditions are calm, withdrawn precisely when they are needed most. In that half-hour window, gold was not traded. It was abandoned by the systems designed to sustain orderly markets. The result was not a normal correction, but a mechanical freefall driven by code, speed, and the absence of human discretion. As the gold market was already spiraling under forced liquidations and algorithmic withdrawal, a final destabilizing factor pushed the system from disorder into near paralysis. A technical failure at the Chicago Commodities Exchange, the core hub of global gold price discovery, During the height of the sell-off on the 30th of January 2026, electronic trading on the Chicago Mercantile Exchange was partially disrupted due to a malfunction in the data center cooling system. In a market that depends entirely on uninterrupted real-time data flow, this seemingly mundane infrastructure issue had outsized consequences. The immediate effect was a delay and inconsistency in global price feeds. Trading venues in London, New York, and Asia rely on synchronized data from Chicago to execute futures contracts, hedge positions, and run arbitrage strategies. When those feeds became unstable, prices updating late, volumes desynchronizing, or connections dropping altogether, the market's informational backbone fractured. In such conditions, price quotes lose credibility. Participants no longer know which price is real, which is stale, and which venue reflects true supply and demand. For arbitrage algorithms, whose sole function is to exploit tiny price discrepancies across exchanges, this environment is intolerable. These systems require millisecond-level accuracy. When data integrity breaks down, their risk models immediately flag the situation as untradeable. The programmed response is defensive and absolute. Flatten all positions and step aside. As a result, arbitrage desks around the world began liquidating gold exposure simultaneously, not based on market outlook, but on data uncertainty. This reaction intensified the imbalance already present in the order book. Sell orders surged as algorithms exited positions and funds continued to meet margin calls. Meanwhile, buy orders normally supplied by market makers and arbitrageurs evaporated almost entirely. The market effectively lost its shock absorbers. Prices gapped lower not because sellers had grown more aggressive, but because buyers no longer existed at meaningful size. The episode exposed an uncomfortable truth about modern finance. Trillions of dollars in global assets are not just dependent on economic fundamentals or investor confidence, but on the uninterrupted functioning of physical infrastructure, cooling systems, servers, and data cables. Once the dust from the technical collapse began to settle, a crucial distinction became clear. What had failed on the 30th of January 2026 was not the value of gold, but the market mechanism used to trade it. As soon as forced liquidations slowed and algorithmic pressure eased, real demand stepped in with remarkable speed. The aggressive selling that had driven prices down to $4,700 per ounce was met almost immediately by buyers who had been waiting precisely for such a dislocation. This rapid absorption of supply explained why gold was able to rebound sharply within hours, climbing back toward the $4,800–$4,850 range, despite the severity of the preceding crash. Hard data reinforces this conclusion. According to the most recent global market figures covering 2025 through early 2026, total gold demand reached 5,002 metric tons, the highest level ever recorded. This milestone is particularly striking given that it occurred during a period when gold prices had already risen aggressively, setting more than 50 new all-time highs in the prior year. Under classical economic theory, such price levels should suppress demand. Instead, demand expanded, signaling that gold was no longer being treated merely as a speculative asset, but as a form of financial insurance. The composition of that demand, however, has shifted. Purchases by central banks totaled 863 tons, still historically elevated, but down roughly 21% compared to 2024. Rather than weakening the market, this reduction was more than offset by a surge in private and institutional investment. Global investment demand jumped 84% year over year, reaching 2,175 tons. Most notably, gold-backed exchange-traded funds reversed a 4-year trend of persistent outflows, registering net inflows of 801 tons, a decisive signal that long-term capital had returned. This shift explains gold's resilience. Central bank buying is strategic but slow-moving. ETF and private investor demand, by contrast, is responsive and opportunistic. When prices collapsed due to mechanical failures rather than fundamentals, this pool of capital moved in decisively. The rebound from $4,700 was not speculative reflex. It was the market reasserting gold's underlying role as a store of value. The crash exposed structural fragility, but the recovery confirmed something far more important. Gold's real foundation remains intact. While retail investors were still processing the shock of the collapse, the response from Wall Street's largest institutions was notably restrained. Instead of cutting forecasts or questioning gold's long-term role, several major players signaled that the events of the 30th of January 2026 had not altered their core outlook. Among the most influential voices was UBS, which surprised markets by maintaining its year-end 2026 gold price target at $6,200 per ounce, unchanged despite the nearly $900 intraday crash. The message was clear. The sell-off was viewed as a technical shock, not a fundamental breakdown. UBS analysts emphasized that structural drivers supporting gold remain firmly in place. Persistent geopolitical instability, elevated inflation risks, and rising sovereign debt levels continue to underpin long-term demand. In a more extreme scenario, UBS outlined that renewed escalation in the Middle East, particularly involving Iran, could propel gold substantially higher. Should regional tensions disrupt energy markets, trade routes, or global risk sentiment, UBS estimates gold could reach as high as $7,200 per ounce, a level reflecting crisis-driven capital flows rather than speculative excess. This scenario analysis reinforced the idea that gold's upside is closely linked to systemic risk, not short-term price noise. A similar perspective was voiced by Jeffrey Gundlach, often referred to as the bond king, due to his long track record in fixed-income markets. In the aftermath of the crash, Gundlach reiterated a position he has held consistently: sell the US dollar and increase exposure to real assets, particularly gold and land. His reasoning centers on the trajectory of US public finances. By 2026, US federal debt had climbed well beyond 36 trillion USD, while interest expenses alone were consuming a growing share of government revenue. In Gundlach's view, such debt dynamics make long-term dollar debasement increasingly likely. From this standpoint, gold's violent short-term fluctuations do not undermine its purpose. On the contrary, they highlight the stress within the global monetary system. Wall Street's calm reaction underscores a crucial divide. While short-term traders experienced devastation, long-horizon capital interpreted the crash as confirmation of systemic fragility. For institutions like UBS and investors like Gundlach, gold remains less a trade and more a form of monetary insurance, one whose relevance grows precisely when markets appear most unstable. The $900 collapse on the 30th of January 2026 was dramatic, violent, and emotionally exhausting, but it was not the end of gold's role in the global financial system. If anything, it served as a necessary purge. What the market witnessed was a cleansing of hot money, leveraged positions, and short-term speculation that had accumulated during months of uninterrupted gains. When prices fell nearly 20% in less than 1 hour, the first casualties were not long-term holders, but traders operating on borrowed capital and fragile confidence. More importantly, the event became a psychological stress test. It exposed who truly understood why they owned gold and who was merely chasing momentum. In an era where over 90% of trading is driven by algorithms, and where fiat currencies can be expanded at will through debt and monetary stimulus, volatility is no longer an exception, it is the baseline. In such an environment, survival is not determined by timing the perfect entry or exit, but by capital preservation, discipline, and patience. Gold's function has never been to make investors rich overnight. Its role is far more fundamental, to protect purchasing power when systems become unstable. The swift rebound from $4,700, supported by real demand rather than speculation, reinforced that role clearly. Short-term price swings may be brutal, but they do not erase thousands of years of monetary history. Thank you for watching this analysis. If you found it valuable, please share your perspective in the comments.